Welcome. Today I'm going to talk to you a little bit about small business valuations, in particular, the Most Probable Selling Price report. We are Advantage Liquidity Partners Limited, and we work with small businesses doing machinery and equipment evaluations and evaluations of small businesses themselves that may be contemplating a sale or some other transaction where the value of the business as a going concern is going to be useful. So, what is an MPSP? Again, stands for Most Probable Selling Price. It's a detailed analysis of the business financial and qualitative characteristics. So we take a look at the numbers and also the various qualitative characteristics of the business, how long it's been in business, what sort of growth prospects it has, what markets in it is it in, what kind of location, et cetera, that the business has. And we compare the business with its peers for benchmarking and valuation purposes. So we're actually able to determine what other businesses have sold for based on private transaction databases that we subscribe to. So we're able to compare, for example, a dry cleaning shop with other dry cleaning shops that have sold and across many different industries. The benchmarking allows us to take a look at what the gross margin, for example, of other businesses in the industry might be and compare that to the subject business to see whether the business is over or underperforming its peers. And the report gives you an estimation of the probable selling price of the business under normal small and medium-sized business transaction terms. What does that mean? Well, small and medium-sized businesses are rarely sold on cash terms. You don't typically sell a business and get a check on closing day. Usually there is some degree of seller financing or clawbacks or some kind of contingent payment based on certain benchmarks being hit, etc. And this is what makes it different from an appraisal. An appraisal is typically defined as what something will sell for when cash is being exchanged for that item. And rarely do small businesses get sold on those particular kinds of terms. So, because the database of comparison is filled with transactions that didn't sell on a cash basis, then we also have to assume that the results we come up with in the report are going to be based on similar terms being discovered between a buyer and seller through a negotiation in the market. So, with that explanation, let's take a look at the tool that we use to build these and the report. So, let me flip over to Excel. And this is a huge database modeling system that we take advantage of. And basically, we start off by putting in all of the financial information, in this case, the income statements that were provided to us under the reported column. And then we have to do what's called financial normalization or normalizing of financial statements. Some people call it recasting, where we have to make market adjustments between the way that someone might make choices about how they run their business versus what we call a normalized operating circumstance. So, for example, somebody who owns a business may choose to pay themselves $100,000 a year as a salary, for example. But if they hired somebody to run their business, perhaps the market wage of doing that role might be $60,000 a year. So there's nothing wrong with someone choosing to pay themselves more if the business can afford it. But the reality is that their time in the business every day may be worth $60,000, the fair market value. The other $40,000 is really part of the business profit. It's just that the owner is choosing to take it out in the form of a salary. And so we need to make these kinds of normalizing adjustments so that we can answer the question, what would the performance of the business have looked like if someone else had bought the business years ago and ran it strictly, quote unquote, by the book? And so we often need to make adjustments to owners' wages, to rent expenses if the business owner also owns the building. We sometimes have to make adjustments to other things, like sometimes there'll be a spouse or children that are in the business that are not being paid a fair market wage as well. So we go through and we make these normalizing adjustments so that we can get this normal market performance of the business. We do projections where we figure out what the future is likely to look like. And in particular, the periods that are just coming up may form part of the transaction analysis. We put in the balance sheet. And in the balance sheet, we need to make a determination as to what kind of transaction is likely going to be envisioned, whether it's going to be an asset sale or a share sale, and under what sort of conditions. So, for example, a share sale to a stranger might be done under what's called a cash free, debt free basis. where the cash in the business will be retained by the seller and any debts will be paid off at the bank. Why? Because oftentimes in small business, the owner of the business has personally guaranteed those debts. And so they don't want to sell the shares of the company to someone else and have someone else take over a credit line, for example, that the original owner had guaranteed. So under that sales scenario, we would want to normalize or adjust the balance sheet to remove those long-term debts, assuming that they're going to be paid off at closing. Now, a different situation could arise, for example, if you're looking at selling a small percentage of the company's shares to maybe to an employee, in which case you may not be refinancing the long-term debts or removing cash from the business. And so the normalization of the balance sheet or the adjustment of the balance sheet is going to be important based on what kind of transaction or purpose you have in doing the evaluation. For an asset sale, for example, oftentimes um, current assets and liabilities, the operating capital, if you will, is not being transferred. The seller will retain their receivables, pay off their payables, and the buyer will put in their own operating capital. So all of these things have to be foreseen so that we can create a report that actually addresses the circumstance of the person that is using the report, whether that's someone who is buying or selling a business and under the conditions that they anticipate the transaction to be in. Sometimes we will do these and then make further adjustments over time as things evolve, perhaps in a negotiation. The report, or the system rather, covers all kinds of pieces of information, and a lot of this will end up in the final report. We do our benchmarking analysis, et cetera, where we do comparison. In this case, we had a benchmarking cost of sales, wage level, and occupancy costs. And then the system was able to compare this particular business with its peers. And you can see here some of the costs were over or under what was expected in the industry. And then we do our evaluation. And so in here, we will actually do a weighting of the years so we can determine what subject set of data we want to use for the evaluation. In this case, a 30% weighting on the 2021 year, 60% weighting on the 2022 financial performance, and a 10% weighting on what was projected for 2023. There are many different methodologies for evaluating a business. You can see here there's several income approaches, some market approaches, and cost approaches. And so research was done to determine what sort of multiples or multiples of sellers' discretionary earnings or factors of revenue would be apropos for this kind of business. And then the methodologies themselves were weighted. And you're going to see this again in the report that we're going to look at. And so all of this is information that has to be filled in to narrow down the output of the report to make sure that we are getting something that makes sense for the user. Now, let's take a look at the actual report. So this is what the report looks like, comes as a PDF document and starts off with a transmittal letter between us and the user of the report. And this has all been made anonymous. This covers the purpose, scope, notice. There's a disclaimer here about the use of the report and a summary of information. We then have sort of the information that was provided to us. So here's the historical balance sheets and the income statements that were given over. And then we talk about normalizing the balance sheet. So this shows what is foreseen to be included in the transaction and what will not be, based on the type of sale that we believe we're going to have. And then we talk about the income statement adjustments. So this was the normalization, things like owner's compensation, the rent, other payroll adjustments, lease costs, et cetera, that had to be adjusted for things like one-time expenses, or in this case, some government programs with respect to the pandemic. And then we have our normalized historical. So this is what would the performance of the business had been over the last 4 years, in this case, if everything had been run, quote unquote, by the book without any special one-time events or anything like that. And that this forms the basis of the evaluation. We do forward-looking projections, with the most recent year being the most important, but we show what we expect the performance of the business to be and under what circumstances. So this one is simply saying that sales will grow at inflationary rates, which at the time might have been 4% a year, and then what we expect. So for example, direct costs to remain constant as a percentage of sales, Other expenses are either going to be tied to revenue or grow at inflation, or maybe be given a budget, for example. Some of these small ones like travel, you can see just 500, 500, 600, 600. That's just a budget based on past spending. We then have our assumptions with respect to weighting. So you can see here that a 30% weight was put on 2021, the 60% on 22, and 10% on the projection. We saw that in the tool. And as well as some other assumptions. So some assumptions here about capital expenditures. In this case, it's foreseen that 1% of revenue will be reinvested in machinery and equipment every year, and the business needs about $10,000 of operating capital. And we forecast what we think the borrowing capacity of the assets might be. We then do an assessment of key value drivers. This is a tool that allows us to take qualitative factors and work them into the mathematical valuation of the business. So the story that I like to tell here is that if you look at two businesses across the street from each other, and they're both doing the same amount of cash flow to their owners, mathematically they'll both have the same value. But if one of them is more nicely decorated and the staff are in nicer uniforms and it's, well lit and bright and just a more pleasant place to be, if you ask someone which business would you rather own, they're going to point to the nicer looking one. And so that's an example of a qualitative factor. So in this tool, we look at things like historical profitability, income risk, business growth, the terms of sale, what kind of competitive environment there is, how dependent the business is on the owner, location, marketability, desirability, and the type of business with respect to service versus something with a high capital asset component. We look at all of these different things, and you can see they have a different weighting. And in this case, the business would have a slight premium to our research because several of these factors are weighted a little bit heavier than average. We then see the results of our benchmarking analysis, and you can see the dotted line represents the industry average for these different areas, and the solid line represents the actual company costs. So you can see how this business performs relative to others in its industry. And then we talk about the actual analysis work that goes into the MPSP. Here's the results of the three different valuation methodologies that were used. So in this case, one in the income methodology and two of them based on market valuations, or comparing this business to other similar companies. And then we have to weight these approaches. So you'll see that we put a 40% weight each on the two market approaches and a 20% weighting on the income approach. And this graph shows us the difference between what this value would be with or without the required net position in working capital. We then have our final summary, and you can see here that the enterprise value determined through this work based on an asset sale was $236,000. And then from that, we have to remove the normal required net working capital of $10,000. And so it's telling us that this business would have, in an asset sale, a value of $226,000, which would be inclusive of the $15,000 of inventory. And we highlighted here that the real estate was not included because this business owned its own building. And in the normalization process, we had to remove that aspect through including a fair market rent. So what would this business performance have been if they were paying rent to rent the building that they're located in? And that's because real estate is valued in a very different way from how businesses are valued. In order to determine the value of the commercial property, in this case, you'd need to actually engage a commercial real estate appraiser. And then we have a closing balance sheet. So what is the net proceeds for the seller? Because not only will this person be getting the money from the buyer of the business, they'll also be holding on to certain aspects of the operating capital. And in this case, they will actually also be retaining the building. And of course, certain liabilities like the loan on that building, the mortgage. And then there's an appendix which includes explanation of the different valuation methods that were used in this particular report, and then a glossary of terms, and then a biography of the appraiser, and further information. And so that's what it looks like inside a most probable selling price report. If you have a project for us, if you're interested in learning what the value of a small business might be, then head over to BusinessAndAssetValues.com. Under the Contact Us tab, you can find our phone number, email address, etc. And we'd be more than happy to talk with you about your project and what we would require in order to go ahead and do this kind of evaluation to show you what the value of this business may be. And with that, we'll say thank you.